I've received so many comments on YouTube for this series on market noise. Clearly it's had an impact on many of you. So firstly, thank you for taking the time to comment and give your thoughts. But there were quite a few of you asking the same thing about noise in relation to volatility. These mostly revolved around whether or not they are effectively a different way of measuring the same characteristic in price action. Well, because so many of you did ask, I decided to tackle the question head on, and I do that straight after this brief message. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. If you're a talented trader looking to attract investor capital to your strategies, Darwinex is the fastest way for you to do this. We enable traders to raise third-party investor capital and then charge success fees on high watermark profits. Additionally, Darwinex itself invests in its traders with our seed capital allocation program that allocates up to 90 million euros per year in successful trading strategies. So, if all of that sounds interesting, learn more by clicking on the link here, or you can find further links in the description right below. Now back to today's tutorial. I'm not at all surprised that I've received so many questions about noise in relation to volatility. It's sometimes difficult to differentiate between them. What does each one tell us about what's happening in the price action? And then how do we use that information to our advantage? Hopefully this and the next two episodes will clear up all of the questions. So let's make a start. So as I said in the introduction, this is really in response to the number of questions that I had asking about noise and volatility. And from the way those questions were phrased, I think some of you were struggling to really differentiate between what these two characteristics of price action tell us. And I have to be honest, I'm not surprised about this because the difference between these two things can sometimes be confusing. And why is this? Well, I think it's because these two different characteristics of price action are very often correlated. So in other words, when noise is high, volatility is also high, and when noise is low, volatility is low. But there are most definitely other times when they are not correlated at all. So we often see times when noise is relatively high, but volatility is low, and vice versa. So clearly, these two characteristics are not the same thing, and they do often act independently of each other. But before we go into look at this in a bit more detail, I think we have to answer this question. Why are the differences important to understand? And the answer to that is that noise and volatility are used for different reasons in trading. At a very high level, one of them can be used to match different styles of trading strategy to the most appropriate assets, time frames and trading conditions. And this, if you've been watching the series, is how we can use market noise. And the other can be used to help manage risk in terms of both your positions and your overall portfolio. It can help to inform position sizing and also your stop loss strategy. And here, of course, I'm referring to volatility. And so if we're not completely clear about what the differences between these are, it means that we can't use them as effectively to inform these decisions. So I'm now going to focus on a brief comparison of noise versus volatility. And first of all, a recap of what we've already looked at in this mini-series. So in terms of noise, this defines how efficient or otherwise price action moves are. And I always think it helps to categorize price action into two broad groups. Meaningful price moves, and these tend to be the longer term moves, and then more random-like price moves that happen shorter term. And looking at the conceptual price action on the right-hand side here, the more meaningful moves are those shown in green. And these, of course, are what we're trying to target with our trading strategies. But in order to do that, we have to take into consideration these shorter term moves indicated in red, as the price fluctuates up and down continually as it travels in the direction of that more meaningful move. And the lower the ratio of the noise to the meaningful price action, the higher the efficiency of those meaningful moves. And vice versa, the higher the ratio of noise, then the less efficient they are. And if you remember, the reason that we analyze this data is to assist with our symbol selection and instantaneous filtering in order to produce the kind of improvements in performance that we saw in previous episodes. So hopefully that helps as a brief recap to what we've already studied, but now let's turn our attention to volatility. And the simplest way to think about this, in my view, is to think about the magnitude of moves in the price action. And small moves over a set period of time means low volatility, whereas larger moves in the same period of time means high volatility. Now, I've heard many people talk about risk and volatility interchangeably as if they're the same thing. And although they are very closely related, I do like to distinguish in order to aid my own understanding. And for me, it's volatility that can assist with the measurement and management of risk. More specifically, the analysis of historical volatility in a particular asset helps you to determine what the relative risk of a potential trade in that asset will be. Okay, so just think about this for a while because this is crucially important. It's that historical analysis that we've undertaken to understand the volatility of different assets that then helps to inform how and if we take a trade and how we manage the risk from the beginning of that trade all the way until it closes. So this is quite different to how I've been talking about using noise. Now, one thing for certain is that a thorough understanding of volatility is required in order to successfully manage risk in the best way in our trading. Now, volatility is something that I've covered in passing in many of the episodes I've covered in the past, but I've never focused specifically on volatility, but I'm going to put that right soon. And in the future, there will be a dedicated series just to the concepts and the use of volatility analysis to improve our trading results and specifically to reduce risk. And I'd anticipate that this series would be starting sometime in November or maybe early December. But until then, let me just give you a brief overview of the impact of volatility. And if we've assessed a range of assets, those assets that are highly volatile mean that when we trade those, if the price moves against your position, this can cause losses to increase rapidly. And this is one of the reasons, of course, why it's so important not to over leverage our positions. Because when prices do move against us in this way, this just multiplies the risk. Now, for lower volatility assets, severe losses tend to be less likely. It's not to say they won't happen, and if there are any major economic releases, these can of course cause the volatility to change, but under normal circumstances, lower volatility usually suggests lower risk. But turning this on its head, of course, volatility isn't always bad, because the converse is true. With high volatility assets, when these move in the favour of your position, it will of course rapidly increase the profit of your trade. And indeed, there are many different types of trading strategy where you'll actually find it difficult to trade them under low volatility. And so a level of volatility can also work in your favour. Now this brings me on to the next episode. And what I'm going to be looking at here is the relationship between volatility and noise and show how that changes over time. But most importantly, what the implications are for the assessment of these characteristics in your own trading. Now, as normal, if that episode is already available, then you'll be able to see a link to it top right now. Also, if you want to find out more about Darwinex, then you can click on the link right underneath. But now, until next time, trade safe.